I want to talk real quick about some stuff that I've learned about moving averages over the years. You may or may not heard of this, but if you use 50 and 100 day moving averages, when the long-term moving average is underneath the short-term moving average, it is bullish. When the long-term moving average is over top of the short-term moving average, it is bearish. When the long-term moving average crosses above the short-term moving average, that's called a death star, indicating a downturn in the stock or a downturn in the market. And the opposite for when the short-term crosses above the long-term, which is called a golden star. One way you can look at these for long-term trading or investing is using the 50-day and the 100-day moving average. So right here on my red line, I have the 50-day, and the yellow I have the 200-day. You can see right here, we have a perfect example of a death star. But if you can quickly see, the downside of this is by the time these lines actually crossed over, the stock had already dropped significantly. So the problem we have here is moving averages that are 50-day, 200-day, they're looking, longer time frames, which cause them to be slower. If you're trading, day trading, swing trading, a 50-day moving average should be only used if the stock is trading above both of them, as you see here, be considered bullish, or if it's trading below, it would be considered bearish. So if it's below it, you're looking to buy puts, or if it's above it, you're looking to buy calls. You should never be buying calls in a situation like this when it's below both moving averages. But how could we have seen this big dip? It would have been too late if we looked at the 50-day and 200-day average. I use shorter term moving averages. Here I have 3 moving averages. The orange being the shortest. I have a mid-range and a 21-day range. So when you can see the orange moving average here is my shortest term. When it's on top, the stock's going up. When it's on the bottom, the stock's going down. And the same works with the shorter term moving averages as it does longer term moving averages. So when this short term moving average here on this orange line crosses through the longer term moving averages, it's a very bearish signal. And you can see right here, the day before and the same day that the stock started to downturn, it crossed, indicating you need to get out of this trade. On top of that, you have heavy volume confirming the price action here on this drop. It'd be a great way to buy puts, and definitely tell you need to get out of this trade. A little bit better as far as options trading, day trading, swing trading, since typically we look at, or I personally look at, a year at most, 6 months, 3 months, and I slowly break it down. And then when I eventually enter a trade, or I go to enter a trade, I'm looking at a daily chart on 5 minutes. I don't like 1 minute, it's too fast for me. I don't like 15 minutes, it's too slow. Here I have SCHW on a daily 5-minute chart. So say I'm looking to enter this trade, or I've already been in this trade. If I'm looking to buy this for a day trade or a swing trade, yeah, it'd been great to buy it down here this day. But what you're really looking for is this crossover right here. When this faster moving average crosses above all the longer term moving averages, that's confirmation and a super bullish signal. And this would have been a great entry point here when the stock broke through all these moving averages, and your faster moving average is now trading above your slowing moving averages. This is a bullish signal. On top of that, you have to look at volume. So here, back here, when it first started to cross over right here, huge volume. And you always have to make sure that you have volume supporting the price. And the stock is bullish and still going up, but you have to watch. You don't have too heavy volume, so you really need to keep a close eye on this trade. And then you start getting more bullish and more bullish, and as these moving averages start to spread apart, that's even more bullish. It's starting to steady out. It's starting to confirm this new trend, and then you start getting heavier volume, heavier volume, heavier volume, and this volume is what is supporting this price. And this yellow line on here is the moving average that I have for volume. So anytime that the volume is touching or breaking past this yellow line, I have above average volume. So that's basically saying the volume is higher over whatever this average is. I think it's 10-day, but it takes, or a 10 period moving average. So it takes, for the last 10 periods, the average volume starts breaking above average volume, and then here you have huge buying right here, confirming the trend. If you had gotten in just as a day trade for this stock, and you say you didn't get in until here, until it really started going up, you would have got in at around, we'll say, 33.50, and you could have sold right before close at 34.34. If you had 10 call options and you had a 50-cent delta, you would have made probably $500 in a matter of a couple of hours. So that's really a quick way. Didn't want to go too in depth or really explain my different moving averages. I'll use that for a different video, but I just want to use this as a beginner tip. Moving averages, short-term moving averages, is good for day trading, swing trading, not long-term trading. Longer-term moving averages need to be used for long-term investing. So if you're day trading or you're looking at a daily chart, you do not necessarily be looking at 50 and 200-day moving averages. It's great for confirming a bullish or bearish trend over the long term, but not on a daily chart.